So if we take a step back and we look at client positioning statistics back in January, what we saw was a market that was incredibly stretched. We had warning bells going off, particularly around growth and momentum trades. And you started to see that sort of violently snap back. And so you've seen extreme outperformance of value as a market factor over the course of the last month and a half. That's largely taken a lot of the crowded positioning out of the market. And so the fact that you've had this really extreme value rally on a short-term basis sets us up for a rebound in growth. And you're seeing that in the tech space today. You're seeing that in many of the ESG related spaces today. You're also seeing that in more risky assets like crypto names, as you mentioned earlier in the show. The JPMorgan expectation, however, is that you are going to see cyclicals and more defensive names continue the rally after we get past this period of adjustment. So what we've seen is a very, very sharp rebound in value. You're likely to see a bounce in growth as a result of the extremity of that market move. On a medium to long-term basis, though, we still see cyclicals and defensive leading this market higher.
Are there any particular sectors within the cyclicals and the defensives that you would be backing right now, considering that there are a number of sectors like financials, for example, which could potentially, from an earnings perspective, see quite a re-rating to the upside in this environment?
I would definitely agree on the financial side. The steepening of the yield curve is very positive for the overall profitability of large financial institutions. That's both banks as well as insurance. We're overweight both sectors. We'd also point to the resumption of consumption spending. You mentioned earlier in the show that there was this view that the stimulus checks in the U.S. would end up in savings accounts rather than in the tillers of local vendors. We wouldn't take that view. If we look at the mobility statistics that we track on a high-frequency basis coming out of the United States right now, we are seeing a very strong resumption in mobility. We're seeing very strong consumption trends across the board. If we look at Chase credit card data, we're seeing very consistent trends. So we would be positive on both financials and consumer as a result.
James, good morning. Thank you for joining in this conversation. I'm a bit worried about where the market is in terms of inflation expectations versus what the Fed is communicating to the markets right now and their stand. And that gap, could that increase volatility in the coming weeks and months? And is that something that you're constantly rationalizing with clients?
Tender, it's a great question. And you've hit on the second of the major debates that we're having with clients right now. The first is the ability for growth to resume leadership in markets. We take the opposite view and argue that after a rebound, you'll have a value and cyclicals leadership dynamic as we go through the rest of 2021. The second major debate is absolutely on inflation expectations. And this is something that's absolutely critical. We are seeing inflation on JPMorgan statistics sitting at 3%. That's the highest in over 10 years. You're seeing in particular services sector PMI at levels that we haven't seen since 2010, 2011. And so there's very clearly a fear that inflation is creeping back in a very structural way. That is not the JPMorgan base case. We do see supply chain constraints pushing inflation higher over the very short term. However, over the medium term, we still see significant slack in both labor and product markets, leading inflation lower as we go into the second half. And so it's a very interesting market dynamic right now, where you have this scare that growth might start to work again. Investor positioning may or may not be reflecting that, as well as this inflation scare. We would fade both of those as we look into the second half, however.